Let's continue with the income statement method for adjusting entries. We're back at Pink Ink, a wholesaler who sells products to retailers. Note that we're doing 2020 and 2021. We're standing in December 31st, which is the year end, and they record adjusting entries annually, which allows us to calculate the correct amount, and they use the income statement method, no reversing entries. Let's page down, read the question. 2. A business purchases a 1-year, 12-month insurance policy for $2,400 cash on March 1st, 2020. The policy coverage begins immediately. On March 1st, 2021, the company purchases a replacement 1-year policy for $3,420 for cash. Again, you can imagine that the policy coverage would begin immediately because the previous policy from 2020, of course, would have ended by the end of February. All right, we're dealing with 2020 first. There's no opening balance on January 1st, just to simplify this question. So we're going to focus on the purchase on March 1st, 2020. What did the company get? They got an insurance policy, and under the balance sheet method, we would recognize 100% as an asset, but we're using the income statement method, so we're going to expense 100% of this insurance policy on the day we purchase it. Insurance expense. $2,400. What did we give away? We gave away cold hard cash. $2,400. Now, fast forward to December 31st, 2020. What did the company actually consume? Let's page down, do the calculation. I'm doing it for December 31st, 2020. What was used? Well, from March 1st all the way to December 31st, we used the policy to protect the company, and therefore we have used or consumed it. For how many months? March, April, May, June, July, August, September, October, November, December, 10 months. So we're going to take the policy, $2,400. We're going to divide it by the 12 months of coverage. We're going to multiply it times the 10. How much was actually consumed? Well, $2,000 worth. However, if we look at the T accounts right now, insurance expense is sitting at $2,400. And what balance do we actually need in the expense? We need only $2,000 in the expense. So what entry do we need to fix the insurance expense? We've got to move from a larger debit to a smaller debit. So we're going to have to do a credit against it to remove the $400 that has not as yet been used or consumed. That $400 is actually an asset called prepaid insurance. And that asset has to be recognized as an asset because it has future economic benefit. So there's our entry. Let's go up and do it. On December 31st, 2020, we have to debit the asset prepaid insurance, $400. Why? Because this is the amount that has future economic benefit, and therefore we can't expense it because it hasn't been used or consumed yet. We also have to draw down the insurance expense because we didn't use or consume $400 worth of insurance. Credit, insurance expense, $400. Let's look at the statement of financial position and the income statement at the end of 2020. On the statement of financial position, we've got assets, current assets, prepaid insurance, $400. We also have on the income statement operating expenses, insurance expense, $2,000. You'll notice if you flip back to the balance sheet method that our financial statements look exactly the same under the income statement method as they did under the balance sheet method. We still have an asset which has future economic benefit, and we have an expense because it's being used or consumed. The only thing I did was I expensed everything to begin with and then pulled off of the income statement what had not as yet been used or consumed. Let's move forward to 2021. On March 1st, 2021, we buy a new policy, a replacement policy for $3,420. Remember, we're using the income statement method, so I'm going to expense 100% of this policy. Debit insurance expense, $3,420. What did I give up? Cold hard cash, $3,420. Fast forward to December 31st, 2021. What do I need to do on that date? Let's go down, do the T accounts, which is the best way to do anything on the income statement method. At the beginning of the year, I had $400 sitting in the prepaid insurance account on the statement of financial position, and my insurance expense was zero on January 1st, 2021. Then, during the period, I purchased for cash an additional $3,420 of insurance, and I expensed 100% of it. Now let's think about this carefully. The prepaid insurance, $400, is related to the period from January 1st, 2021 to February 28th, 2021. Don't forget what date I'm standing in. I'm standing in December 31st, 2021. So how much of this insurance has expired, being used or consumed to help generate revenue? 100% of it. None of it belongs as an asset anymore. But now let's look at the other insurance policy that I purchased. This is from March 1st, 2021, all the way to February 28th, 2022. How much have I used or consumed this year? Well, from March 1st all the way to December 31st, 2021. That's March, April, May, June, July, August, September, October, November, December. 10 months. I have used 10 months. What is unused? 2 months. Therefore, 2 months of this insurance policy have future economic benefit, and they have to go back onto the statement of financial position. Let me calculate the 2 months that are unused. $3,420 divided by 12 multiplied times the 2 months unused is equal to what? $570. $570 has future economic benefit. That $570 belongs as an asset on the statement of financial position. So on my T account, I want to put down, what do I want my prepaid insurance to be? I want my prepaid insurance to be $570. How do I get there? Well, I have a debit of $400 and I need a larger debit. So I'm going to solve for X. What is that amount? $170. If I do an adjusting entry for $170 debit prepaid insurance, it will show the ending balance in prepaid insurance equal to the amount of insurance that has future economic benefit. Now, if I do a debit to the prepaid insurance, I'm going to have to balance that entry with a credit to insurance expense for $170. What will my insurance expense be at the end of the year? $3,420 minus $170 is equal to $3,250. That's the amount of insurance that was used or consumed during 2021. I could calculate that amount if I wanted to. I would take the $400 and I would add in the 10 months of insurance that I used, and it would come up to $3,250. I choose to calculate the amount of future economic benefit that is remaining, but you could choose to calculate the amount that has been used or consumed. Either way, the entry will be $170. I promise you that. Let's do the entry. December 31st, 2021. The adjusting entry will be a debit to prepaid insurance, $170. And it'll be a credit to the insurance expense, $170. What will my financial statements look like at December 31st, 2021? My statement of financial position: assets, current assets, prepaid insurance, $570. My income statement: operating expenses, insurance expense, $3,250. So notice my financial statements are perfect. My statement of financial position reflects the future economic benefit of my insurance policy that remains. And my income statement reflects the insurance expense that was used or consumed to help generate revenue. Prepayment adjusting entries: insurance expense under the income statement method.